Hi, I'm Randy Pifer with Active Insurance Solutions here in Grand Junction, Colorado. I want to welcome you to what I hope will be an easy to understand series on the Accountable Care Act. I just had a call from a client this week. What he said was, I guess it's about time I start paying attention to this stuff. Well, indeed it is time. And I assure you, everyone is going to have some choices to make regarding the Accountable Care Act coming up in the near future. Nancy Pelosi put it this way: let's pass this bill so that we can see what's inside of it. Well, the time has come to look, and look we will. First off, I want you to understand that you can just go ahead and relax for a little while, because we do have a long way to go. Although the timeline for implementation of the Accountable Care Act has already been established, there are a number of things that are still yet to be determined, the biggest of which are rules and regulations that are going to govern the way the law is implemented. Those are right now work in progress, and those rules and regulations are going to come out in large volume over the coming months. There are a number of things that are already in place regarding the Accountable Care Act. I'm going to go over a few of those with you. First off, insurance companies can no longer impose any lifetime maximum on an insured contract. They also are no longer allowed to impose any pre-existing condition limits for children under the age of 19. In addition, children can now stay on parents' policies until the end of the month in which they turn age 26. Another requirement of the insurance carriers is to provide expanded benefits for women's preventive health care. Some of those items include birth control pills, breast pumps and supplies, as well as sterilization procedures, all covered at 100% with no out-of-pocket cost to the customer. Another requirement is now referred to as minimum loss ratio requirements to insurance carriers. How this works is when an insurance company takes in a dollar's worth of premium, they are now required to pay out at least 80% of that benefit directly back to their customers. That allows them to retain 20% for all of their ongoing expenses, such as salaries and benefits that they may be providing already to their employees. Do you notice a pattern here? What's going on is that the initial implementation processes have been aimed directly at the insurance carriers. Please understand, any additional benefits or mandates that are required for them to provide under an insurance contract certainly are not going to cost less and absolutely will cost more money. In the future, I intend to cover a number of additional topics, certainly those that are going to affect you directly as an individual, as well as you as an employer group. I hope to answer most of your questions in the coming topics in this series, as well as possibly answer questions that you may not even be thinking about. If you do have anything that you would like me to address, I would appreciate if you would put a comment at the end of this video. I want to take an opportunity to right now just thank my clients, my friends, and my family for tuning in. In closing, I would like to pose a question back to you. What do you suppose is your personal responsibility in all this? Stay tuned. Until next time, good health. That's the plan.